On September 17, 2019, something happened that should have dominated financial headlines around the world. Instead, most people never heard about it. There were no crowds gathering outside banks. There were no emergency television broadcasts. The stock market didn't immediately crash. No famous company suddenly declared bankruptcy. To the average person, it was a completely normal Tuesday. But deep beneath the visible economy, inside a financial system most people never see, money suddenly became difficult to find. Not consumer money, not savings accounts, not credit cards. The money banks used to keep the entire financial system operating. And for a brief moment, one of the most important financial systems in the world nearly stopped functioning. The strange part is that this happened only months before the COVID pandemic. Many people assume the first major financial warning sign appeared in 2020. In reality, something was already breaking beneath the surface, and almost nobody noticed. To understand what happened, we need to start with a simple question. What happens when a bank needs money for just one night? Most people imagine banks as giant vaults filled with cash. The reality is far more complicated. Banks constantly move money. They borrow, they lend, they transfer, they settle obligations. Every day, enormous amounts of money flow through the financial system. Because of this, banks occasionally find themselves needing cash temporarily, not because they are failing, not because they are bankrupt, simply because timing matters. One bank may need cash today. Another bank may have extra cash available today. The solution seems obvious. One bank lends to another. Tomorrow, the loan is repaid. Simple. But when these transactions happen among the largest institutions in the world, they take place inside a market most people have never heard of. The repo market. Repo is short for repurchase agreement. The name sounds technical. The concept is surprisingly simple. One institution provides cash. The other provides collateral, usually U.S. Treasury securities. The next day, the transaction reverses. Cash goes back, collateral goes back, and the system continues operating. This market rarely appears in news headlines, yet every day, hundreds of billions of dollars move through it. Some estimates place activity in the trillions. Think about that for a moment. Trillions of dollars moving through a market that most people have never heard of. This is one of the defining characteristics of the invisible economy. The systems with the greatest influence are often the least visible. Roads are more important than cars. Electrical grids are more important than appliances. And financial plumbing is often more important than stock prices. Most people focus on markets. Professionals focus on liquidity. Because markets can survive bad news, they cannot survive a complete lack of liquidity. Liquidity is one of the most misunderstood concepts in finance. People often confuse liquidity with wealth. The two are not the same. A person can own $1 million house and still struggle to pay a bill tomorrow. A company can own valuable assets and still run out of cash. A bank can appear healthy and still face liquidity problems. Liquidity is access. Liquidity is availability. Liquidity is the ability to obtain cash when needed. And on September 17, 2019, liquidity suddenly became scarce. Something strange happened. Interest rates inside the repo market began rising dramatically. Normally, these rates moved within a predictable range. Then they surged, and they surged fast. Some rates reportedly approached 10%. That may not sound dramatic, but inside a market built around overnight lending, it was shocking. Imagine driving your car and seeing the temperature gauge suddenly jump into the red zone. The engine may still be running, the vehicle may still be moving, but something is clearly wrong. That is what financial professionals saw. A system designed to function smoothly was suddenly showing signs of stress. The obvious question was why? Why would institutions suddenly become reluctant to lend cash? What changed? The answer is surprisingly complicated, and that complexity is part of the reason the story never received widespread attention. Several factors appear to have collided at the same time. Corporate tax payments were due. Treasury settlements were occurring. Cash was leaving parts of the system. Reserves inside banks were lower than many expected. Each factor alone might not have caused a problem. Together they created pressure. Pressure creates stress. Stress reveals weaknesses. And when enough stress accumulates, hidden systems become visible. This pattern appears throughout history. Bridges reveal weaknesses under heavy loads. Electrical grids reveal weaknesses during extreme weather. Financial systems reveal weaknesses during liquidity shortages. Pressure exposes architecture. The repo market crisis exposed architecture. For years, most people had assumed the financial system was operating normally. Then, suddenly, the Federal Reserve stepped in. This was significant. The Federal Reserve is not supposed to intervene casually. When it acts, markets pay attention. At least they usually do. But this intervention occurred largely outside public awareness. The Fed began injecting liquidity into the system. Billions of dollars, then more billions, then hundreds of billions. The goal was straightforward: restore confidence, restore liquidity, restore normal functioning, and eventually, it worked. The immediate crisis passed, money began moving again, interest rates stabilized. Financial markets continued operating. To many observers, the problem appeared solved. But the more interesting question remained unanswered. Why had the system become vulnerable in the first place? This is where the story becomes larger than the repo market itself. Because the crisis revealed something important about modern finance. The economy most people see is not the economy making decisions. It is the economy reflecting decisions already made. By the time a problem reaches the visible economy, it often began somewhere deeper, somewhere hidden, somewhere inside infrastructure. Most people monitor stock prices. Financial professionals monitor liquidity. Most people watch earnings reports. Financial professionals watch funding markets. Most people focus on companies. Financial professionals focus on systems. The difference matters because systems determine what companies can do. Infrastructure determines what markets can do. And liquidity determines what systems can do. This is why events like the repo crisis deserve attention, not because they are dramatic, but because they reveal mechanisms that usually remain invisible. Imagine a city where every traffic light suddenly stopped functioning. The roads would still exist. The cars would still exist. Drivers would still exist. Yet movement would become difficult, not because the city disappeared, but because coordination disappeared. Liquidity functions similarly. It helps coordinate financial activity. When liquidity becomes scarce, the system becomes less efficient, less predictable, more fragile. One of the lessons from 2008 was that financial systems are deeply interconnected. The repo market episode reinforced that lesson. A problem in one corner of the system can spread rapidly, not because institutions are identical, but because they are connected. Connection creates efficiency. Connection also creates vulnerability. This is another invisible economy principle. The same structures that create strength can also create weakness. The internet connects billions of people. It also spreads misinformation quickly. Supply chains create abundance. They also create dependencies. Financial networks create liquidity. They also create transmission channels for stress. The repo market was one such network. Most people never noticed because the visible economy continued functioning. Paychecks arrived, stores remained open, businesses operated normally. Nothing obvious appeared wrong. Yet behind the scenes, enormous effort was required to stabilize the situation. That effort raises an uncomfortable question. How many other invisible systems are operating successfully only because constant intervention prevents problems from becoming visible? The answer is difficult to measure, because successful intervention often looks like nothing happened. When a crisis is prevented, headlines rarely celebrate the disaster that never occurred. People only see what happened. They rarely see what almost happened. The repo market episode belongs in the category of events that almost happened, a financial disruption that was contained before most people became aware of it, but the fact that it was contained does not make it unimportant. In some ways, it makes it more important, because it offers a rare glimpse into the hidden machinery beneath modern finance, a glimpse into the systems responsible for keeping money moving, and movement matters. Modern economies depend on movement, money moving, credit moving, payments moving, confidence moving. The moment movement slows, stress begins accumulating. The moment movement stops, larger problems emerge. This is why the title of this episode matters. The day money almost stopped moving, not because every dollar froze, not because every transaction failed, but because one of the most important channels supporting financial activity suddenly experienced strain. And when that happened, it revealed something most people never think about. Money is not just a thing. Money is a flow, an ongoing process, a network of relationships, a system of trust, liquidity, collateral, and coordination. The visible economy shows us outcomes. The invisible economy shows us processes. Most people spend their lives observing outcomes. Few ever see the processes. Yet the processes determine everything. The repo market crisis is a reminder that the economy is not simply built on dollars. It is built on movement. And for a brief moment in September 2019, one of the most important forms of financial movement nearly came to a halt. Most people never noticed. But the system did. And sometimes the most important economic stories are the ones nobody sees.